the best of money matters. Wealth Tracker.
Welcome to the Wealth Tracker, where we dive into the uncharted territories of niche investment strategies that promise to redefine wealth. Hello, I'm Hongbin Jeong. Gold has once again captured the spotlight, shining brightly in the portfolios of investors worldwide. This surge isn't just a retail phenomenon, it's institutional. Now, central banks are steadily accumulating reserves, and as a recent Morningstar report highlights, global gold ETF assets have exploded, growing sixfold over the past decade to surpass $375 billion. Now, the first half of 2025 alone saw the largest semi-annual inflows in 10 years. This begs critical questions for any serious investor. Is this just a temporary safe haven rush, or are we witnessing a fundamental reassessment of gold's role in a modern portfolio? How does incorporating this asset actually impact a diversified strategy? And with so many ways to assess it, how does one choose the right vehicle? Well, to find out more, I'm joined by Sam Hui, who's a senior analyst of manager research at Morningstar. Sam, welcome to the show.
Hello, Hongbin. Thank you for having me here today. Really happy to discuss this hot topic.
Thank you so much for joining us. I'm super excited as well. Well, Sam, there are several factors that's been driving gold's sustained growth, whether it be, U.S. inflationary pressures, negative real interest rates, or weaker USD and geopolitical tensions. But which do you see as the most, persistent long-term driver for gold demand, and which might be more transient?
That is a great question. So gold has indeed experienced considerable investor interest and sustained price appreciation in recent years, driven by various factors, including what you just mentioned about inflation in the U.S., periods of negative real interest rates, a weaker U.S. dollar, and geopolitical tensions. So these factors will change from time to time, actually. For instance, we have negative real interest rate a few years ago. If you still recall, global central banks lowered policy rates in 2020 to combat the COVID pandemic. Inflation started to pick up, and then the U.S. Fed began an aggressive rate hiking cycle in 2022. Policy rate now is much higher than the level we saw in 2020 and 2021, and U.S. inflation has somewhat come down from its peak in mid-2022. We no longer see negative real interest rate today. Geopolitical tension also will change over time. For example, in terms of trade tensions, we saw it escalate with the Liberation Day in April this year, and then de-escalate somewhat afterward. And the market certainly reacted very quickly to that. So these events will always change. But I think more important is for us to understand what are the underlying motivations for people to buy gold, which may not change that much. It is generally perceived as a hedge against inflation and a safe haven asset. And also, some people see diversification benefit by having gold in their portfolio. Of course, some people may also be buying gold for short-term speculation, which requires caution.
Okay, well then with this backdrop, Sam, what happens when you incorporate gold into a multi-asset portfolio, and how should investors position themselves accordingly?
So let's take a step back. And why do we want to have a multi-asset portfolio? Why do we want more than one asset class? So asset class return can fluctuate significantly over time. Equities may outperform during certain periods, while fixed income can take the lead in others. If we include a diverse range of asset classes that behave differently in different environments, we can achieve smoother portfolio outcomes and better risk-adjusted return through cycles. So that's called the diversification benefit. For this to work, the key is we need asset classes with low or negative correlation with each other. And correlation between gold and traditional asset class, especially equities, is pretty low. Don't take me wrong, I'm not suggesting to construct a portfolio with just equities and gold. But there are different things we need to understand before incorporating gold in a multi-asset portfolio.
Okay, well then speaking of which, how does gold affect a classic 60-40 portfolio then?
That is a great question. It actually depends on how we fund the gold allocation. We did a study on that, and the results are shown in our Going for Gold research paper. So in the first scenario, we fund the gold allocation by reducing the portfolio's exposure to equities. We tested a few cases such as 5% to gold, 10% to gold, and then 15%. As we increase gold allocation and decrease equity allocation, we see the expected risk of the portfolio decrease notably. There is also an improvement in the risk-adjusted return of the portfolio as measured by Sharpe ratio. So overall, this demonstrates the diversification benefits of gold. So it is the benefits when you mix a variety of asset classes which have low correlation with each other so that they behave and perform different in different environments. Of course, the other side of the coin is the expected return. We see the expected return decrease slightly as we add more gold, and this is because of the lower return potential of gold compared with equities, particularly Asia equities. Certainly, you will also ask, so what happens if we fund the gold allocation by reducing the portfolio exposure to fixed income instead? And the story will be quite different. As we do the same test by increasing gold allocation but reduce fixed income allocation, it meaningfully pushes up the portfolio expected risk while increasing its expected return only slightly. So this is a trade-off that investors must carefully evaluate.
Right. So for a risk-averse investor then, which funding method, from equities or from fixed income would you recommend?
Just now I mentioned that funding gold allocation by reducing fixed income exposure would push up the portfolio risk. I think it's also good to look at more data. For instance, if we look at the maximum drawdown for gold in the past 20 years, that was about 40%, compared with global bond or Asian bond, roughly 20%. Global equity and Asia equity was more than 50%. So you can have a sense of how risky gold can also be in terms of the drawdown. Next, we also look at the standard deviation of return for gold. Similarly, we look at the past 20 years. The standard deviation of gold price was actually about 17%. And to the surprise of some investors, that's actually higher than global equities 15%, while global bond standard deviation was around mid-single digit. So while gold is generally seen as an inflation hedge and a safe haven asset, these tell us that we should not overlook its volatile nature. We have to be careful that the performance profile of gold can differ materially from defensive assets such as fixed income and cash, and gold is not really a replacement to fixed income and cash. Its impact on the portfolio would depend on the funding source.
Okay. Well, then in a scenario where both bonds and gold are falling, how would you defend gold's place in the portfolio?
So before I answer this, just for the record, I'm not trying to defend gold's place in the portfolio. I think it's natural to see that sometimes the asset classes go up together or go down together or go in different directions. Or maybe what you're suggesting here is they go against our expectations of how they should correlate with each other over the longer term. It's actually more surprising to see they perform exactly the same as the model at every point of time. So certainly we don't want all asset classes in our portfolio to fall at the same time, but that could happen from time to time. So what do we do in this case? It really comes down to why did we include the asset class in the portfolio at the first place? And revisit if there have been any fundamental or structural changes that result in our assumptions no longer valid. For instance, when we first introduced the gold allocation in the portfolio, we might be assuming it has low correlation with other traditional asset class. But certain things can also change, and that assumption may also change, and something we have to continuously evaluate. And from there, if we do see a change in the case in terms of the assumption, we may have to consider adjusting our strategic positioning.
Well, speaking of allocations as well, what are the pros and cons of assessing exposure to gold via, gold funds or ETFs, multi-asset funds, and gold mining funds, Sam?
So there are different ways we can gain exposure to gold. Of course, one way would be to buy the physical gold bullion or jewelry. When it comes to managed investment, just as you mentioned, there are choices such as gold ETF, funds, and mining funds. So gold ETFs are very popular. We saw a tremendous inflow into these products in the first half of this year, more than any semi-annual inflow over the past 10 years. So these passively managed gold funds and ETF, they track the price of physical gold. They offer a relatively liquid, low-cost means for investors to gain exposure to the metal. For physically backed strategies, each unit typically represents a fixed quantity and purity of gold. stored in vaults. So you can imagine, unlike physical bullion or jewelry, having gold funds and ETF eliminate the storage and security concerns for investors. We don't have to worry about, for instance, the physical gold at our apartment being stolen away. Gold ETFs also offer daily trading on exchange, so it's like stock, but of long-term investment horizon. Now, talking about gold mining funds, they may be less alone. Gold mining funds invest in companies engaged in gold extraction and production. These companies or stocks can potentially outperform gold prices during bull market because of their operating leverage. Of course, they can also underperform gold prices on the flip side. In other words, these gold mining funds offer a leverage way to invest in physical gold. Performance of gold mining funds is influenced by company-specific factors and general market movements in addition to the gold price. These gold mining funds do not try to track the gold price. They are typically actively managed, and they tend to charge higher fees than passively managed gold ETF and gold funds.
Well, meanwhile, multi-asset funds, they offer dynamic allocation, but, cap gold exposure. So is the main value proposition here the convenience and active management, or is there a genuine potential in how these funds tactically, allocate to gold?
Yes, you're right that multi-asset allocation funds offer a one-stop solution for investors seeking diversified exposure across asset classes, primarily equities and fixed income, and to a smaller extent, alternative assets such as gold. So gold exposure can vary in these funds depending on their strategic orientation and outlook, typically capped and indirect. So it may not appeal to those seeking a more specific allocation to gold. Also, the asset allocation methodology would be different across these different multi-asset funds. Some may employ fixed allocation, the others can employ dynamic or model-based allocation. So it is important to evaluate these funds' philosophy and transparency, especially for those prioritizing gold exposure.
Okay, well, with so many different options then in place to invest in gold, Sam, how does one pick the perfect vehicle for them?
Yep, so it really depends on the objective because these products serve different purposes. For instance, passive gold ETF aim to track the gold price, but some investors may want more than just tracking the gold price. They may want the potential to outperform gold price, and they are willing to take on stock-specific risk. Then gold mining fund would be for that aim. Some investors may actually be looking for a one-stop solution rather than just having some gold exposure. Then multi-asset funds will serve that purpose. Certainly, there are different factors to consider when we evaluate different types of product. Take the case for passive gold ETF, for example. So expense ratios and tracking error are very important things to look at. A lower cost will directly enhance long-term returns. Tracking error measures how closely the ETF mirrors gold spot prices. Lower tracking error indicate better alignment with gold's performance. Liquidity and trading volume are also some key considerations. Like high trading volume ensure tighter bid-ask spread, facilitate more efficient entry and exit, while they also trade ETF may incur higher transaction costs. Fund size is also something to consider. And for actively managed gold mining funds and multi-asset funds, it's important to assess the capability of the investment team and the investment processes.
Right. Well, alternatively, how can one pick an investment that's as good as gold at the moment?
I think just as I mentioned, it's really important to understand how these different types of product work and understand one's investment goal. The risk appetite is more about whether that product is suitable for that person's objective. And when you have a suitable product type in mind, the next would be to try to get more details about the product, understand more about the investment team. For the case of passively managed gold ETF, we may also want to look at key metrics such as the expense ratio, the tracking error. So doing due diligence would be very important to pick investment as good as gold.
Overall, is now a good time to increase a strategic allocation to gold then, Sam? And conversely, what would signal a time to reduce it?
That is a very good question. So it's never easy to time the market, and be it for gold or equity or other asset classes. And when we make portfolio decisions, we shall look across asset classes. So not just about whether to increase or decrease exposure to gold, but where to reallocate to gold or from gold. How's the relative attractiveness of different asset classes? As I highlighted earlier, gold price was very volatile. So we do not really try to use it as a replacement for defensive asset because they have very different performance profile and risk profile. And we should be mindful of not investing in gold just because of the recent price momentum. Having a long-term mindset and a long-term game plan is crucial for achieving financial success.
Well, some great insights from you there. Thank you so much, Sam, for joining me today.
Thank you, Hongbin.
Thank you. That was Sam Hui, Senior Analyst of Manager Research at Morningstar. This has been the Wealth Tracker with me, Hongbin Jeong.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance. To listen to more great interviews, download our podcasts at audio.sg or download the audio app. That's AWEDIO, audio at the App Store and Google Play.